Jeremy Harper, big episode.
Morning.
I've never seen a preparation deck quite this big. There's two of them for people who are watching. Now, mate, first thing I want to warn the audience is you better get your pen and paper down and you better take notes because there's some good juice coming in here. We've rushed this one through because there is the budget change coming on, or the budget, announcement coming on Tuesday.
Yes.
And mate, what we want to run through is a few things that people may have forgotten, like the stage 3 tax cuts that ended up getting changed because of our good friends in the Labor government. We want to talk about the capital gains tax changes and the history of CGT, when it changed from inflation-based to discounted, and what it's going to look like if it's changed back.
Yep. Negative
gearing, what that looks like currently, what it's going to look like potentially if it gets changed in, and then obviously the historical data of that, and the impact it will likely have again because we have history to show us what it's going to do again. The tax on potential trust distributions now just being a flat rate of 30% and the impact that could potentially have. And then we were running the other day and you said you were going to request this and you have requested it.
Yeah, a bit of homework.
What is this?
It's a freedom of information pack from the government. So we'll get to that, but I want to understand some of the numbers they were sprouting earlier this year.
What is this though? People need to know this because they need to hang around to listen so they get this information.
That's the workings
for all these changes.
Some of these assumptions.
Right.
Yeah. So
I didn't know you could do this. You can request from the government information that they're currently, working with inside the government.
Yep. You're within your right. There's channels there. You're legally allowed to do it. It's how a lot of journalists they'll in the background request this information. That's how they'll generate their content.
There you go. You're not just a pretty face, Jeremy Harper. All right. So, mate, let's dive into it. So the first thing we want to run through is the tax cuts that a couple of years ago were announced. The stage 3 tax cuts. That was meant to save us on income tax. We're going to change some tax brackets as to how we're paying tax. And it was going to be a good thing for everyone.
Mm-hmm. Yes.
That didn't come to fruition in its standard form.
So let's have a look at the background. So, people will think, well, both these governments are the two sides of the same coin, but actually under this scenario, it's not the case at all. So 2018, there was 3 stages that the coalition, Liberals, put through.
Yep.
Stage 3 was the last tax cut, which was really addressing the bracket creep. So that was legislated, it was approved by government on both sides.
And just for people who don't understand what bracket creep is we've had the same tax brackets for many, many years.
Yep.
$190,000, say, was our top tax bracket. It used to be 180, now it's 190. And that's when you start to pay 47 cents in the dollar on anything over and above that.
Yep.
$190,000 10 years ago or 20 years ago was a lot more than what it is right now. So those numbers haven't changed, but the tax rates kick in still at those numbers. So a lot more people today would earn 190 than they did 20 years ago, which means the government's collecting more tax revenue just simply by not changing them and allowing people to creep into those high tax brackets.
Correct. And the big change was the 37% bracket, which was from, basically they're flattening that out. That was what we agreed to, out to 30%. So closer to your corporate tax rate. So that was going to be anyone from 45,000 up to 200, flat.
Flat tax rate of 30%.
Now, who can't get behind that, really?
For sure.
Yeah, I think that seems simple. But then in January 24, the Albanese government, they went back on that. They broke their promise. They said they weren't going to, and they did. So now we're back to a watered-down version. So they reduced the top, well, they've increased the top bracket up to 190 now, but essentially kept the original 5 tax brackets. So that's where we're at today.
Right, which means you're paying more tax than what you would have been paying.
Yep.
If the Liberal government was able to bring in what they had said they were bringing in.
And that's why every second conversation you have with someone is saying, I'm working harder, I'm getting a pay rise. It's not reflected, right? Because they're paying higher taxes. So if you think about, I know it sounds like a high number, but if you think about someone on a $200,000 taxable income, it's an additional $9,000 per year.
Which is 5% of what you're earning.
Correct.
Net.
Yep. And if you look at that, and I know that they gave a little bit more back on the lower end when the government changed it, but if you think about those 2 changes over a 10-year period, that's an extra $45,000.
But the vast majority of people are not those lower people. They're people earning, $50,000 to $200,000.
Correct.
That's the vast majority of the population.
So I think as we go through today, keep that in the back of mind. We're paying more tax on your taxable income now, today, and then when we layer these CGT changes on top of that, you can see it's a twofold effect.
Now, I think what's important is I never used to have much of a political view, and this was only recently. Like I didn't really care about politics. I was like, fuck, I can do more for my life than what a government will ever do. But I'm starting to care more about politics now because you obviously realise as you pay more attention how much of an effect they can have on the economy and how it operates and the confidence and all the rest of it. So, it's interesting. So let's talk through it. So that's the first thing.
Yep.
Labor government fucked it up, essentially. You're paying more tax because of Labor. And historically, what has been known is under a Labor government, they spend more.
Yes.
You pay more income tax versus a Liberal government. Generally, you will pay lower taxes, they spend less, and they run the country more like a business.
Yep.
That's generally historical.
And if you think about, one of their levers, the ATO, if you speak to any business owner, the ATO is ruthless at the moment in terms of collecting tax.
Revenue, correct.
They're defaulting business owners. They're going hard. So that's a reflection of the government.
Even land tax.
Correct.
Like, I remember 4 years ago, you get a land tax notice. No one's chasing that shit up. You just let it sit there and eventually they chase it up and then you pay it. Now, like my land tax was due maybe 3 weeks ago. Soon it was overdue. They're bang hammering the accountant with a letter.
Yep. So let's talk about CGT because this is going to be one of the hot topics of the budget.
It is the hot topic, right?
So should we give a little bit of background on?
Let's give some background. How we got here. What's the current CGT, and the tax rates? How's it work?
Yep.
What was it before the changes, and why did it change? What year did it change in? And what's it likely to look like after the change if they do bring it in?
So originally, September 1985, Hawke Keating government, they brought in a CGT to basically capture the value of someone selling an asset, which prior to that period was CGT free, which was great for those people back in the early 80s.
You could sell properties and not pay tax on it, or sell assets.
What a time.
Give me more of that.
And so from 85 to 1999, they had a inflation-based cost base. So essentially they would revalue the cost base based on when you acquired and then what is the adjusted for inflation cost base when you sell.
Meaning $1 million you paid for it, you sell it 10 years later. Over that period of time, we've had 50% inflation. So your cost base would be $1.5 million, and then anything you sold over that is what you pay tax on.
Correct. One of the things, so they had a Ralph tax review in September 1999. This was under the Liberal government. They looked at how can we simplify these things. Now, at that same time, they had to bring GST in, so they needed a bit of a sweetener to get people over because GST wasn't particularly popular at the time.
Yeah.
And that's where they landed on the 50% tax rate. Not just that, it was actually at the time, if you think about computers, it was incredibly hard to calculate your cost base. Think about back then. Accountants are often getting the calculation wrong, so they're like, how do we simplify it? They go, what was your cost base? What did you sell it for? You get a 50% gain. And of course, if you look at the timeline, if you sell early or sell late, you're going to have vastly different tax outcomes, but it was a simplified version. And that was to essentially look at anything sold in an individual or a trust name over that 12-month period or greater. So if you sold it within 12 months, you didn't get that discount.
Yep, which obviously disincentivise flipping and things like that versus if you hold an asset for long-term performance, obviously you got a 50% discount, which means like you made $1 million, that gets added to your taxable income.
Yes. You
would only pay tax on 50% of that gain, or you would pay the 50% tax rate on the total thing.
Correct.
Yeah.
So let's fast forward to sort of...
So that come in 1999.
Yes. And we've had that
when
in place.
Costello was in.
Yep.
He was also the same treasurer that got us to a budget surplus, 0% debt by 2006, I believe it was.
Started the Future Fund.
Yeah. And since then, we've accumulated $1 trillion worth of debt, which means we've spent every dollar of Australian revenue generated during that period of time, and spend an extra $50 billion over and above that in debt.
You've been doing your homework.
Something like that.
So that brings us to today. So it's been leaked, and again, we are saying this before the budget night, but there's a very, very high chance that it's
Should we have a budget party?
Budget party. What do you reckon?
Joel looks like he's keen for the budget party. Get some drum and bass music.
So it's been all but confirmed that they want to remove the 50% discount, and they want to go back to 1999. So we want to go back in time, back to the indexation model.
Right.
Now, this will go into my freedom of information document later. It kind of all ties in, but they're now, they started to leak this initially that it was only going to be on residential property. but it looks like it's going to be across all asset classes.
Which means regardless if you invest in property, shares, crypto, business, there's no discount. You've just, the only incentive you're getting is whatever inflation is created over that period of time.
Yep.
Comes off what you end up paying on your cost base.
So a few things I think about initially is simplicity. Are we creating a simpler tax system if we do indexation? No, we're not. We're creating more work for everyone. So bigger ATO. I'm sure they'll create a department on confirming have you done your indexation calculations correctly versus a simple 50%.
Mm-hmm.
So more room for error. More time spent away from actually producing and generating value to this country. So that's one thing. And I just think it creates an overly complex system if they go down this pathway. And then the second thing is this was pitched as a way to address housing affordability. So if I'm taxing your shares, what does that got to do with property?
Not sure. Fuck all, to be honest.
Yep, correct.
So it's not good.
Not good.
Not good at all. How will they work it out? Like if we go 1999 pre, it's like who sets the rate of inflation for that year and
So my understanding will be you'll have the CPI, which is released every quarter, the quarterly print, and that will be pegged. So you'll calculate when did you sell closest to that quarterly print or that readout, and then you add that onto the cost base.
Which means if Labor stay in government and keep running inflation as hot as it's running due to government spending, it means that your cost base is actually going to be increasing probably at a similar value to what the asset's increasing by.
Correct.
If we're running at 4, 5, 6% inflation every year,
yes,
that's not too dissimilar from the long-term Australian growth rate it's been on property at say 7%.
We do have an example on that we'll get to later to show that. So you're spot on. In a high inflation environment, it may not be a huge difference on the 50%. It just comes down to the complexity and what's a simpler tax system, and we're definitely moving away from that. So great work, great business boom for accountants out there. It's going to be more work for them, but it's going
Henderson Accounting coming soon, 1 July.
So that's the CGT.
Another thing I wanted to mention, which we didn't talk about in our original extra tax we're paying, is the Division 296 that Labor also brought in, which is on superannuation, right?
Correct.
No one cares about it right now when they're young and they don't have much in super, but you start becoming more successful in life and start building your super balance, and you'll be paying 30% on everything over and above, 3 million per person?
Correct.
40% over and above 10 million.
My concern around that goes to property as well and leverage. So how do they calculate?
Well, it's net asset value, right? But
could that be tweaked in the future? Could
Who
they
knows?
exclude lending within the fund? So then your gross assets are inflated, right? So if you've got $1 million property with a $500,000 loan in your super fund, because we do know that Labor obviously not fans of self-managed super funds. They want everyone to be an industry fund. That's what they'd like. So could that get attacked into the future?
And then also remember that they were going to tax unrealised gains.
Correct.
That was a Labor idea.
Yep.
They're great people. Tax on. All right, so that's the capital gains tax change. Essentially, removing the 50% discount, simplicity of the 50% discount, going back to an inflation-based model, not just on property as first suspected. It's likely to be on all assets that generate capital. Appreciation. So, okay. Negative gearing's the next one.
Yes. So this one, there's potentially it could be restricted to one investment property per person. Some are saying it could be new dwellings only, and then there's a carve out there that existing properties could be grandfathered. But I guess over to you, if negative gearing or the interest deduction is reduced, what do you think that does to rents in the market?
I mean, two things on that. One is the market will only pay what they can afford to pay, right? So there is no doubt it's going to increase it, because if it affects all investors and all investors lift rents because they want to make up for it, then the market's going to lift and people are going to have to pay it, which means they'll be sacrificing in other areas of their life. And that's not a good thing. And then the second thing is the negative gearing at the moment gets offset against your taxable income, which means like if you own an investment property, you get a little bit more back in tax, and it allows you to spend more money. So that's going to affect those people as well.
Correct.
But what they're talking about now potentially is just capturing all those losses to then offset them in the future against a future income gain. Is that right?
Potentially, or limit that, or carry it forward. I mean, it's This one, the devil will be in the detail. I don't know.
So let's explain what negative gearing is now. Negative gearing essentially is you have an investment property. It's not just property. Like you can claim losses on any investment that you have expenses on that's over and above what it's making you.
Correct.
So
debt recycling, shares.
Correct. Yeah. So you've got an investment property. Let's use property as the example. It's bringing you in $50,000 a year in rental income, but it's costing you $70,000 in interest and property-related expenses like council rates and all that shit. So that $20,000 disparity at the moment, if you own the property personally, can be offset against your personal income.
Yep.
And if you're on the highest tax bracket, you get potentially 47% of that money back, of which then gets spent back in the economy.
Yes. And then this goes back to our intro talking about the higher taxes. So if you think about it, we've got some stats here. 41% in Australia of our revenue comes from personal income tax. The OECD average is 24%. So we're actually the second highest country in the world in the OECD in terms of collecting income from our personal income tax share. I think we're only behind Denmark. So we're up there. So if you think about if you're trying to put more tax on the individual, people are going to look at things like negative gearing. And that's probably why it's become more of a sort of a mainstream idea.
Because we're paying so much income tax. Right?
Correct.
It's like, fuck, how do we pay less tax? Well, we invest in property and we can claim that as a deduction.
Correct. So this has a little bit to play out in terms of how they'll capture this. The idea, I mean, what's your thoughts on if they were to look at restricting to say new dwellings only? What does that do to the private renovation, development market?
Well, look, the challenge now with new. And I had this fucking debate with the CEO or whatever he is of the Australian Institute. Fuck, I could have strangled the bloke. People just think that, if we incentivize new dwellings, they will just be built, right? It's like, if we disincentivize people to buy established properties and investments, and we just incentivize new, people will go and buy new. But that's one piece of the puzzle.
Yep.
The reason more new properties are not being built, and Harry Triguboff said this only recently, I think maybe a week ago, it's because they're not feasible. That's why they're not being. By the time you buy the land, you bring in the infrastructure that you need, you develop it, you then build the dwelling on top of the fucking thing, all of the interest costs associated with borrowing the money to do it, and then you sell it, there's no money in it. So regardless of how much you incentivize new, the person or the developer who develops it needs to be able to make money.
Yeah.
So it's not going to happen. Like right now in Victoria, which is where you spend a lot of your time, you can buy established apartments cheaper than what it would cost you to replace that one today. Hence the reason they're not being built. Yeah. Unless you're in the high end of the market. Unless you're the downsizer or you're the person spending $1.5 to $2 million. If you're someone sub $1 million, a first home buyer trying to get into the marketplace, you can't build them for what you have to sell them cheaper than what it's going to cost you to build them. So it doesn't make sense to do it.
Yeah.
So just incentivizing it from a tax point of view, like, go do more new. It's not going to make the feasibilities work any better.
Yeah.
And I know this for a fact because we run so many of these fucking things. You buy a block of land, you work out how much it's going to cost you to develop, you work out what the resales are. I did one the other day. It was 1,000 square meter block of land in Merewether. And we're always thinking about, who are the buyers right now? It's either your downsizer or your first home buyer. They're the two biggest buyer pools in the market. Downsizers don't usually have debt. First home buyers don't care because they just like buying a property. That downsizer doesn't stack. First home buyer needs to be under 1.5 million in New South Wales so people get the full exemptions.
Yep. And
it doesn't stack. There was a 7% net margin on it. So one fuck up or one, being slightly off on your resales and them coming in 50 grand less than what you think they are, and you don't make money. So it's like it doesn't work.
Yeah. One incentive that I've seen work is actually in Queensland. So if you're buying as a first home buyer, if you're off the plan, stamp duty is full exempt. There's no cap on that, which I actually think is great because it incentivizes people.
Yeah, but it doesn't make it any more feasible for the developer.
No, but it means you could probably charge a higher price on the
potentially.
Budget.
Yeah, if the market can pay it.
Yeah.
So I think there's a few pieces to the puzzle, and as we know, brand new is often not the best kind of asset to be investing in.
Yeah.
You're generally in outer locations or in inferior suburbs or pockets of suburbs with apartments. And I'm against it massively. Infill development slightly different. Good suburb, you redevelop a block and bring in townhouses or duplex or something different, but older stuff no.
And funny you say that, Mr. Henderson, because New Zealand in 2021, so pretty recently, they banned deducting interest for rental investors. So over in New Zealand, so quite recently, rents went up. There wasn't a benefit to first-time buyers, as you just said, and they actually reversed it completely in April 25. So I know a lot of people go back to an example back in 1985 about rents going up, back in Hawke when this came through.
Because they tried to remove negative gearing before, right?
Yeah, but I mean, that may be a slightly different market, but I think looking at the New Zealand example is pretty recent, so that's something we should be aware of.
And when you look at rents rising 25% across 2 years, when there wasn't the disparity between supply and demand like there is right now, it was way better back then. Sure, we're in high inflationary times then as well, so if you said 50% of that 25% increase was from inflation and the other 50% was market increases, it's going to be worse now, guaranteed.
Yeah, correct. Should we talk about the trust tax?
Yeah, let's talk about the potential changes to tax on trust distributions, because apparently only rich people use trusts.
Yeah, so again, it looks like they want to impose a minimum 30% tax on all trust distributions.
So let's talk about how this works now. So currently, let's say you run a business, right? Business profit goes into, like your trust owns the shares of your business. Profit gets pushed up into there. Let's say you've got a wife that doesn't work, and a mother that might be elderly that doesn't work. You push some money out to them as income, and they pay tax on it just at normal tax rates. First 18,600 whatever it is tax free. That from that. They're trying to stop that now. They're trying to say, well, if you're dispersing income through a trust to minimise tax, well, we're just going to tax you to flat 30%, which is what you pay. If you've got a company doing more than 50 million, and fucking blows my mind.
So
also people think, you can distribute to kids at the moment, which you can't. Anyone under the age of 18,
you can only, I think it's like $600 or $300.
And anything over and above that, I think you pay like 45% tax, so it doesn't make any sense.
And you think about, when does the 30% tax rate kick in as an individual now? It's not much. It's 45%.
Something like that, 45 grand or something, yeah.
So I think for me, it's an attack on business owners. The driving behind this is, you could put, instead of doing trust distribution to someone that maybe, quite often small business, those people are helping out in the business, right? So they might be doing administration, as you know, business works 24/7, small business owners. I think they're just trying to get people onto the PLYG model. So instead of distributing to your partner,
you just
employ them. You employ them.
And then they go, payroll tax, superannuation.
I think it's the superannuation. They want to capture a little bit more into the big super fund. So that's very much Labor, right? They want to take that cash flow and tuck it away for the future. They don't like the idea of distributing that full amount to you, and you can do what you want with it. So, I don't see actually a real benefit around from a tax collection point of view doing this, because either way, that individual's paying tax.
Correct.
Just something.
And then on top of this, it's like, trusts have a lot of negatives as well if you own assets inside them. Like you've got, in New South Wales, for example, 0 land tax threshold. So you're paying land tax from $0, 1.6% of the land value. I don't know. It's crazy. And it's crazy to think that they, sure, there are some extremely wealthy people that would have trusts set up. And they would obviously maximise them to the full amount. Same as superannuation, the 296. There would be some people in there that I'm assuming have hundreds of millions or billions of dollars in their tax, because there never used to be a contribution limit in the superannuation. But it's we're talking about the slither of the population, and it's going to affect the vast majority of people who just have these entities set up because they're trying to slightly get ahead.
I think it's going to create more issues. Trusts are there a lot of the time for legal protection,
asset protection,
farms, things like that. I'd love to understand the impact that's going to have to our farmers out there. Another kick in the guts for them.
Like me, I'm a farmer.
That's it.
They call me Farmer Hendo.
All right, should we talk about this? So
let's talk about this.
So as we said earlier, freedom of information. So at the start of this year, we started to see some figures come through the media around the capital gains discounts costing
10 billion.
It's 20 billion. 20 billion at the start of the year.
That's what it's costing, huh? There you go, okay.
And they were conflating that. They were saying that's to do with residential property. And I thought, I need to take a look at that number. It doesn't feel right. So it took me about 3 months of back and forth with government.
So this is a good thing to know, which I never knew until you told me on the run, which was, if they're talking about these things, you can actually request, hey,
what's your work?
Show me what you're working on. Where are you getting these figures from?
Yeah, show me your homework. So here it is here. So I went through it just so you don't have to because it's dry. A lot of it's redacted.
Is this are we allowed to share this
No, I wouldn't.
through a PDF?
Probably.
No.
We'll probably get in trouble.
You're scared.
Well, I don't know. You know, Chalmers might come knocking on the door.
Mate,
But there is actually.
he probably hear us. He's got massive ears. That bloke, huge ears.
You can see the correspondence between Treasury and the departments. A lot of departments. A lot
Like
of people,
emailing and stuff like that.
Yeah. So you can tell. You can get a flavour of
Like the Epstein files, but
what they wanted and where they were trying to take
that
this.
job.
But I think for me, a couple of things stuck out was that 20 billion is actually so the figure that was floated in the media, and floated in media that is quite of a particular leaning.
Left.
Yep, quite supportive. So you go online, you can Google it yourself. So 20 billion was floated out there. Now, the numbers in that document is actually in relation to what they anticipate the capital gains discount for all assets. So the 20 billion is all assets in Australia.
So not just property.
Not just property.
There you go.
So when I couldn't get a breakdown, and then when we think about what's been leaked, and they're thinking about changing the CGT to all assets, and they'll float in the 20 billion, it sort of makes sense now that they'll never really just calculate property alone. They'll calculate all assets. So that tells me potentially that's what they'll look at doing from the start. It wasn't just about property.
So they're saying it's costing $20 billion in
Foregone revenue.
So they're saying that we should be or could be collecting another 20 billion of revenue.
Yep.
Or is it 20 billion of deductions?
20 billion of revenue.
Right.
Yeah. The interesting thing to note is in their own documents, they
So
have
essentially, it's they're collecting about. They're missing out on about 40% of what we're spending on NDIS at the moment.
Correct. Yes.
So if they bring this in, we just start up an NDIS company and just get it back that way.
We'll pay for one state's NDIS bill.
Nice.
That's going to overtake our defence spending. Isn't that unbelievable?
Wow.
Okay, but back to this. So, a couple of things to point out from this document. Their own data, they've made a lot of assumptions. So they actually ranked their own assumptions, and they said future taxpayer behaviour, reliability, they've ranked that as very low. This is their own marking, very low. So what does that mean is they've assumed that a lot of people would transact at a high taxable margin. So they're in a higher tax rate already, and they'll sell that asset. Whereas people will adjust their behaviours, right? If they'll figure out can they have a low taxable income year and dispose that asset at that point, right? That's just tax planning 101. So that's something to note. So it kind of goes to how accurate that calculation is. And secondly, just look at the volatility. So when they put out the estimates in 2023 for 24-25 year, they had that costing as 15.5 bill. Then the following year they revised it up $7 billion,
Which is 50%.
So they've just marked it up just based on their numbers, and then they've revised that back down to 19 billion. So you can see that
they're going, fuck, Greg, I miscalculated this. Give it up, 50%. And the following year they go, fuck, Greg, fuck this up, mate. It's only 19 billion.
So they're big numbers.
It's huge. It's a 50%. 15.5 billion to 22.5 billion is
In
a 50% difference.
And so if you're shaping our conversations in the broader public on these numbers, and they're saying, oopsies, round up, round down every year.
By 50%. I wish I could round up or round down my revenue by 50%.
And their own internal scoring has the behaviour as very low. People just need to kind of take that into consideration. Go and do your own research if you want. This is not my.
This is what I get out of not every government worker, but a lot of these squids. If they're so fucking good at everything they do and they know so much, why don't they go and run their own businesses? There's a reason for that. And that's because they suck. That's the truth. No one in their right mind who is exceptionally talented would be working in government if they could go and do their own thing. That's the reality.
I think there's some good people in government.
Absolutely, there is some good people in government. Well, I'm talking about the top. I'm talking about the top end of government, right?
Yeah.
Like, if that's just my take on it.
So I just think it's really important. People, I know this stuff's dry.
Yeah, but this would not float in a private business. Imagine going to your accountant and him going, "Yeah, mate, it looks like we're going to have this much tax payable, or this is the projections," and then going back to the meeting the following year, and he's like, "Mate, you know those numbers I gave you last year? Yeah, fuck, they were off by 50%."
Yeah.
It's like, what?
Yeah. So people take the time, have a look at this, do your research, just to try and understand this is what is shaping out what's going to come through on Tuesday night.
It's out of control. Now, another thing to float on this was I had a meeting with my accountant yesterday about something completely different. But he was talking about this, and he's like, look, even if these things get announced, in the budget, the reality of them coming in straight away at what they announced is unlikely. Because then they'd have to go through Parliament, and then have to, get ticked off. Like the Division 296 thing, that took 4 years to come into effect.
Yeah.
The original announcement was, this is how we're going to tax things. Then it kept going back through, getting revised, and then it ended up coming to fruition. And that comes into effect from 1 July this year.
Mm.
So it's been many years of the original announcement. Then that was back in the last budget, right?
Yeah.
Look,
I would just push back on that and just say they want to go ahead with this. Quite often, tax changes can be at the night of announcement effective from budget. The challenge we have right now compared to previous governments is they've got a majority in the lower and upper. So you can have some of those independents, crossbenchers, even Liberal kick up a fuss. There might be some amendments, but ultimately it's going to get through if they've got the support of the Greens and some of those crossbenchers, which they do. In fact, the Greens want to go harder with some of these changes. So,
did you see the video of the Greens guy the other day in Mullumbimby who got pulled over by a police officer? You not see it? Oh, mate, you need to go and watch it. If anyone hasn't seen it, just Google Senator, I can't remember his fucking name, Green Senator pulled over for random breath test and random drug test.
Right.
This fucking bloke, like the police officer, right? Public servant, doing his work. There was some festival up there. This is off topic, by the way, but festival up there, I think it has something to do with, CBD or THC festival, I don't know. So he pulls up. So he's like, hey man, how you going? My name's Constable, blah, blah, blah. And then whole mate's like, yeah, my name's Senator David, blah, blah, blah. And he's like, oh, no worries, mate. He's like, oh, this is just a random breath test. You've done one before, yeah, boop, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. He goes, great. And this bloke's just like having at this police officer, you're wasting taxpayer money. Every time I come here, I'm pulled over, blah, blah, blah. And he goes, oh, have you ever done a random drug test before? Yeah, I have, mate. Every time I come here and waste your taxpayer money, blah, blah. And then drives off. Obviously, he wasn't under the influence. But this is a senator, Green senator, meant to be a leader of our country, ragging on a police officer for doing their job. And you would assume, like, hey, we're going to breath test and drug test people if they're going to a festival that relates to this thing. You should look it up. And then when you think about they're the people making decisions in our government, it's like you're a fucking idiot. Anyway.
And then let's go through a bit of an example that we've put together. So if this is more around the capital gains scenario. So if we go from 50% discount back to the indexation model.
Yep.
So we've got this example where someone bought a property for $1 million back in 2020, sold it in June 25 for 1.5, so we've got a nominal gain of $500,000.
Yep. Now
let's just say you're in the top marginal tax rate. Now, the CPI reference, now this goes back to your earlier point. If you were to buy and sell in a high inflation environment, which we are in, the adjusted cost base would be 1.238 mil. So we'll go, not the mil, so we adjust that up for inflation.
So essentially they're saying that you've had almost $40,000 worth of inflationary growth on your asset, not real growth.
Correct.
Right.
So then your real gain is not 500, it's about 261.
Which is what you'd end up paying tax on.
Correct. So if we look at the scenario 1, so the 50% discount as it stands today, you'd be paying tax on the 250. And then so you'd be essentially at the top rate, you're paying about 117,000 in tax.
Cool.
On that gain.
So 117 based on current tax rulings.
Yep. If we adjust that to the indexation model, which is what's floated, it's a 261 gain. So you'd be paying 122,000 in tax. So you really in that scenario, it's only about a $5,000 difference between the two,
which is fuck all.
Which is not significant. So really, where this could catch people is a low inflation environment, which we don't think that's going to. I can't see that happening in the short term.
Not with Labor in power, no.
And then if you had a phenomenal gain on something, so it's going to catch people out. You buy a share in Canva, and it goes up 50 times. You've had that share for 10 years. That's where you'll get called out, right? Because you've done exceptionally well on some sort of asset disposal.
That is well and truly outperformed inflation.
Correct.
Yeah.
Which may not be property, so maybe these other asset classes. So again, does that go back
Which
to...
doesn't really happen with property, right? Like there ain't too many properties where you're getting like extreme growth like you would do out of investing in an early stage company or something like that.
Correct. You know,
Or selling a business. Or
selling a business, that's right. So, or crypto, or some of those assets where, you know, in the space of a couple of years, you could have sort of 20-30% growth, or 20 or 30 times.
Yeah.
So just wanted to kind of break that down for the listeners. And then I guess the third one is...
So just to be clear on that as well, that's a real life example. Like if you bought a property in 2020, it's probably had, you know, more than 50% growth. So, but over that same period of time, we've had almost 30% inflation as well.
Correct.
Yeah.
So I think that's, you know, for people that may be freaking out with all these changes, because it's a lot going on, right? So if you're thinking, I've got property and what do I do? At the, you know, if that goes through, just kind of real life example, it's not going to be a huge difference. I think if they went down to a 33% gain, which was sort of floated, your gain is now 335,000.
So that's instead of getting a 50% discount, you only get a 33% discount.
Then that could significantly, you know, you end up paying sort of $40,000 more tax, which is material.
About a 30% difference. Yeah.
Correct. So yeah, that's just something for the listeners to, and I could even give you these notes. We can pop that on.
That'd be good. I think it'd be really
read
good.
through it. Yeah.
What about we go down to the bottom example?
Yes.
We've got 28-year-old worker. Sounds like Jack Henderson. Actually, he's a good guy.
And this is, again, I'm not having a go at any of the older listeners that are retired. If you've accumulated wealth, good on you. You've worked hard. You've definitely paid your tax. But the way this system is now, very different tax outcomes. So if you're a young worker, 28, your salary is 110,000, and you're trying to sell some shares that you've put away as a deposit. You thought, okay, putting in a cash account's not going to get me much. I'll put in some shares. You're on a 32% tax rate. So if you're looking at selling some of those shares to use towards a purchase, if you look at some of the 50% discount at the moment, you might pay for $4,800 in tax under the new indexation model. So again, it's going to impact people with some selling in a short term where they've had that growth. You're going to be paying sort of $5,782 in tax,
which is essentially another 30%. Close enough to it.
It's going to hit the younger worker that's trying to get into that property.
Yeah.
Versus if you're a retiree, you get a tax-free pension. It's no impact, right? Because you got your tax-free threshold, or you're retired and your super fund is in pension mode.
Yeah.
Zero tax.
Which is how it should be.
Should be that way.
The reality is the people who are in that retired stage now are people who pay tax forever. And guess what? One day, the young 28-year-old, if he does the right things or she does the right things, will also be that person who gets the benefit.
Correct. And then finally, I just want to highlight, and maybe you're across this, but there were some changes around the BTR model.
Build to rent.
Build to rent.
Doesn't really work, this build to rent model, but let's talk through the tax change.
No, it hasn't worked in England. But
build to rent, for people who don't know, is you develop a building, 1,000 apartments, 100 apartments, whatever it is.
Yep.
All of the apartments are rentals.
Correct.
They're all on one title. They're not strataed like a standard apartment building. It's an American model. American apartment buildings. A lot of them are sold in one line, and you can't ever own them as a what's it called? As a buyer. You were just a renter forever.
Correct.
Yeah.
So, recap. Top marginal rate for Australian individuals, 47%. Potentially any family trust distribution is going to go up to 30% on budget night. That's what they want. So 47, 30, keep that at the back of your mind. In the background, so from 1 July 2024, which I missed at the time, they actually reduced this. So previously it was a 30% withholding tax. So if you are a foreign company, let's say you are from Singapore or the US or Japan, and you're investing into Australia, it used to be a withholding of 30% on income and capital gains. That's now been reduced to 15%. So we're giving these foreign companies a 50% chop out. And on top of that, they're increasing the accelerated depreciation from 2.5% to 4%. So essentially, they're allowing these entities, foreign-owned entities, we don't see that benefit of income, a higher deduction.
Which means you can depreciate the asset faster, and you're paying a lot of tax. So you combine depreciation and your tax, and you're not paying a huge amount. Obviously, the reason they've brought that in is because there ain't many Australian businesses, other than our super funds, say, that can afford to fund these things, because they're very capital intensive to go and buy, develop, and build extra accommodation for people. So if they incentivise foreign-owned businesses to come here and build, it works. The challenge is the yields just don't stack in Australia. For the cost that it is to develop versus what you're going to get in rental income, that don't make sense.
Correct. So I guess two things for me is one is, it feels like it's stacking against people or investors.
Well, mate, it has no benefit to the normal punter, right? Sure, bringing more accommodation for people to rent, amazing.
Yep.
But what they should incentivise is your everyday punter to go and do that, not foreign-owned people.
And lowering some of those input costs, right? All the development costs, all the red tape that's gone through.
It's out of control.
How long it takes. So
everyone clips the ticket on the way through.
Correct.
Everyone. Mate, that's very interesting. That's very good stuff. This is fabulous. Freedom of information. Who do you email to get that?
I'll have to. I'll give that to you offline.
Thanks, Greg from the ATO. Grego. So essentially, just in summary, there's some of the changes that we're likely to see come budget, which
Tuesday
is
night.
Not too far away.
Yep.
Time will tell whether that's legit or not. I have this theory in my head, which I hope comes to fruition, but it's like, and I was talking to Conrad from Punters Politics on this about all these changes. Mate, he said to me, to be honest, I don't reckon any of these changes are going to come into effect. I reckon it's just all hype. Because we've seen it before, right? We've seen it before, like, there's going to be changes to this, there's going to be changes to that, and then there's no changes.
Yeah.
So obviously it's got momentum now, it's in the media, it's everywhere. There's a lot now of old videos replaying of Albanese saying, we're not going to touch it, you have my word, we're not touching negative gearing, we're not touching this, and then they're flipping.
Yeah.
Surely they're not naive in the fact that if they do make these changes and they've told everyone they weren't going to make these changes, that's suicide for them as politicians. It doesn't work.
Well, they did that on the stage 3 tax cuts, right? They said they weren't going to touch them, and then they went back on that.
It's like Borat, you will never get this, you will never get this, la 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 la, and then she get this, So yeah, it's going to be interesting. But as always, like we can see back then, we spoke about, there was already changes to capital gains tax from inflation to CGT.
Yep.
The world moves on.
That's it.
There's been constant changes. GST was brought in. I'd love to know the media from back then. GST is going to kill the economy. GST is this. I don't know a world without GST. It's just normal.
Yep.
And it still doesn't fix the underlying problem of supply and demand, which is if it costs more to develop an asset than you can sell that same asset for, then no one's going to develop it unless the government does it and subsidises it, which is going to cost them a lot more than this $20 billion they're trying to save by, potentially changing capital gains tax and shit like that.
Correct.
Jeremy Harper, that was very good. I got a lot out of that. Thank you so much. And we'll see you with the budget party.
Look forward to it. Thank you.